Most people fear missing the next rally. That's the wrong fear. The real danger is holding an asset that looks safe right up until the system reprices it. Because in 2026, the story won't be one headline. It will be one mechanism. Rates stay higher than people expect. Liquidity becomes selective. Weak balance sheets get exposed. And when that happens, some assets don't crash loudly. They bleed quietly. Then they break. Today, I'm going to show you 5 assets that are structurally vulnerable in 2026, not because the world ends, but because the math changes. Not predictions, not hype, just the mechanism. If you understand the mechanism, you stop asking, what should I buy? You start asking, what can't survive when the cost of money stays high? Let's start.
Section 1. The frame. One rule connects everything in this video. When the discount rate rises, the future gets cheaper. That sounds abstract, so here's the plain version. Most assets are priced on tomorrow, profits tomorrow, rent tomorrow, growth tomorrow, refinancing tomorrow. When money was cheap, tomorrow was easy to finance. When money is expensive, tomorrow has to earn its place. That's why higher for longer matters. It doesn't need to be a meltdown. It only needs to last long enough that weak structures can't roll their debt and can't defend their valuations. In the US, the last decade trained people to expect rescue, low rates, easy credit, and liquidity that shows up on time. But a system that rescues everything also teaches people to take positions they don't understand. That's the hidden risk, not the headline, the habit. 2026 is a year where liquidity asks questions first. So the goal isn't to forecast headlines. The goal is to map exposure. 5 assets, 5 vulnerabilities, 1 mechanism.
Section 2. Why 2026 feels different. The refinancing wall. Here's the phrase that explains a lot of 2026. The refinancing wall. In a cheap money era, debt had a magic trick. You didn't have to pay it down. You just had to roll it, and rolling it was cheap. That became a business model. Companies borrowed to buy back stock, real estate owners borrowed to improve returns, consumers borrowed to smooth life. Investors borrowed because leverage made every small edge feel big. Now replay the same world with a higher cost of money. The debt still exists, the maturities still arrive, but the refinancing terms change. That's the wall. Not because everyone hits it at once, but because enough borrowers hit it that the system becomes selective. Second-order effects follow fast. Lenders tighten standards. Cash flow gets redirected from growth to interest expense. Weak projects get delayed or canceled. Paper wealth gets questioned. Risk premiums rise, quietly, across the board. This is why you'll see fine headlines while the system tightens underneath. The economy can look stable while the financing layer becomes hostile. You don't need a dramatic crash to get a meaningful repricing. You just need the system to stop giving discounts to weak balance sheets. Keep that in mind, because every asset on this list is exposed to that same wall. Asset number 1, long-duration bonds, the safe asset that isn't safe. Let's start with the one that surprises people. Long-duration government bonds. Not because the US Treasury is about to default, that's not the claim. The risk is simpler, price risk. Bond math is brutal and simple. Prices move opposite yields, and the longer the duration, the more sensitive the price is to yield changes. Here's a practical way to feel it. If a bond fund has a duration around 15 to 20 years, a 1% move in yields can mean a double-digit price move. That's not politics, that's math. Short bills barely notice, long bonds swing. If yields rise and stay elevated, long-duration holders can bleed for a long time. Here's the US version of the trap. You want safety. You buy a long-term treasury fund or a total bond fund heavy on duration. It feels conservative, adult, responsible. Then yields drift up again, or the market demands higher compensation for time. Your fund falls. Not because the issuer failed, because time got repriced. And the psychological damage matters. People expect volatility in stocks. They don't expect it in safe assets, so they sell at the worst moment and lock in the loss. If you want a mental shortcut, duration is leverage on time. In 2026, the long end can stay sensitive because heavy issuance keeps coming. Demand for duration isn't guaranteed, and inflation uncertainty keeps the term premium alive. That doesn't guarantee a crash, it guarantees vulnerability. Mini case logic. If short rates stay high, long rates don't need to explode. They only need to stay not low. That alone can keep long bonds under pressure. What to watch this year? Not bond news. Watch the long end behavior on ordinary days. If it can't stay calm without a catalyst, it's telling you the market is still searching for a price. Red flags you can watch without being a pro. Long-term yields rising while growth slows. Weak auction demand headlines. Big day-to-day swings in the 10 to 30-year segment. Bond volatility spilling into stocks on the same day. If you don't understand duration, these moves feel random. They aren't. They're the price of time adjusting. Asset number 2, cash, the asset that quietly shrinks. Asset number 2 isn't a product. It's what most people hold by default. Cash. Cash feels safe because the number doesn't go down. But cash has a hidden drawdown, purchasing power. Inflation is not only prices go up, it's value leaking from idle currency, a quiet tax that doesn't require a vote. Even when headline inflation cools, real life can stay sticky. Insurance, healthcare, rent in certain regions, services, maintenance, food categories that don't reverse like electronics. So you can look at a macro chart and feel calm while your monthly budget tightens. US example. Your paycheck rises 4%. Your rent rises 7%. Auto insurance jumps 15%. A simple repair costs more than it used to. Suddenly, the economy is fine, but your life feels tighter. In 2026, holding some cash is rational. Cash is optionality. Cash is your ability to say no. But there's a line where cash stops being optionality and becomes paralysis. People sit in cash waiting for certainty, but certainty usually arrives after prices move. Cash is a tool, not a belief system. A Noir Ledger rule: use cash to buy time. Don't use cash to avoid thinking. A second rule: match cash to purpose. Emergency money is not the same as I'm scared money. One protects you, the other freezes you. Red flags: sticky services inflation, rising insurance and healthcare costs, wage growth slowing while bills keep climbing, consumers shifting from wants to needs spending. Cash doesn't crash, it erodes, and the erosion funds the rest of the system. Asset number 3, leveraged liquidity trades, when collateral stops being free. Now we go beneath the headlines. A huge part of modern markets runs on collateral and funding. Treasuries aren't just investments, they're plumbing. They're posted as collateral, they're reused in repo, they sit under leverage. Here's the mechanism. When rates are higher and volatility rises, funding becomes picky. Haircuts rise, margins tighten, terms get stricter. Trades that looked stable start demanding cash, fast. Then, markets do something ugly. People sell what they can, not what they want. This is how stress spreads. Think of it like oxygen. Collateral is oxygen for leveraged markets. When oxygen thins, everyone breathes harder at the same time. A simple US example you've seen: a day when stocks are down, credit spreads widen, volatility spikes, and the news tries to explain it with one story. But under the surface, the story can be plumbing. Collateral repricing, funding pressure, forced deleveraging. This doesn't require corruption. It requires leverage. Here's the part people miss. Even good assets get sold in funding stress, not because they're bad, because they're liquid. Liquidity becomes the exit door and everyone runs through it. In 2026, the risk is not that every market collapses. The risk is a market that becomes more prone to liquidity events. Quick, sharp moves driven by mechanics, not narrative. What to watch? When the market sells everything at once, ask, who needs cash today? That question is often more accurate than any headline. Red flags: sudden widening in credit spreads, funding stress headlines, and liquidity language, repeated volatility spikes, and everything down days that feel disconnected from news. When liquidity goes selective, the system stops being forgiving. Interlude: how a liquidity event feels in real time. Here's how it usually looks from the outside. First, the market feels normal, and then, suddenly, everything moves together. Not because every company got worse at the same second, because someone somewhere needed cash. Second, people start saying, it's irrational. But liquidity events are not irrational. They are mechanical. They are the system forcing positions back to a size it can actually fund. Third, the story comes later. A headline arrives and everyone pretends the headline caused the move. Most of the time, the move was already happening. The headline just gave people a sentence to repeat. Asset number 4. High dividend stocks and bond proxies. Income isn't safety. This is where disciplined investors get surprised. High dividend stocks, dividend ETFs, utilities, certain REITs, income plays. They're often treated like a calm alternative to bonds, but they carry a similar vulnerability. They compete with risk-free yields. Mechanism: when short-term treasuries offer a strong yield, equity income has to offer either higher yield or higher growth. If it can't, price adjusts downward until the yield looks competitive. That's repricing, not drama, math. Second vulnerability: many bond proxy businesses carry debt. Higher rates mean higher refinancing costs. That compresses cash flow. Cash flow pays dividends. US example: an investor buys a high dividend ETF for stability. Rates stay elevated. The ETF underperforms for a long time, not because the dividend disappeared, because the market keeps comparing it to risk-free yield. Dividend is not a shield. Dividend is a policy, and policies change when the balance sheet tightens. One more layer: income investors often reinvest dividends automatically. That's fine in calm periods. In tightening periods, reinvestment can turn into slow averaging down without realizing the asset is being repriced for a new regime. Red flags: dividend yields meaningfully below risk-free yields for long periods. Payout ratios stretched. Rising interest expense. Businesses reliant on refinancing to maintain distributions. Stable income assets moving like long-duration bonds. In 2026, income becomes a competition. The risk-free alternative is real again. Asset number 5, commercial real estate, the slow avalanche. If you want the clearest structural vulnerability in the US system, it's commercial real estate. Not your personal home, commercial. Office, certain retail, debt-heavy segments of multifamily in some regions, and the debt stack beneath them. Commercial real estate is not a house, it's a cash flow machine. When occupancy drops, cash flow drops. When rates rise, refinancing costs surge. If refinancing costs surge while occupancy is weak, the math fails. And commercial loans mature, they don't last forever. That maturity wall forces reality. In a cheap money era, you could refinance and pretend the problem didn't exist. In a higher rate era, refinancing becomes a stress test. Now add the dangerous connection: regional banks. A lot of commercial exposure sits in regional and community banks. Not always toxic, often normal lending that becomes abnormal when valuations fall. US example: an office building runs half empty. The landlord offers months free to keep tenants.
revenue drops, the loan matures, refinancing happens at a much higher rate, debt service jumps, cash flow can't cover it. Math doesn't negotiate. Commercial real estate rarely crashes like crypto. It grinds, then it gaps, and the gap shows up first in lending standards, appraisals, and bank provisions. A detail that matters in the US. Commercial deals are often made to work on refinancing. If the refinance is the plan is fragile. When that fragility spreads, banks respond the only way they can: tighten. Red flags: rising delinquencies on commercial loans, falling appraisals and valuation resets, banks increasing provisions, refinancing extensions becoming the norm, and persistent vacancy in key corridors. In 2026, you don't need a dramatic recession for this to matter. You only need capital to stay expensive long enough.
Section: The Domino Map. Why these 5 connect? Step back. These 5 aren't random. They're connected by one thread. The cost of money determines what survives. Long bonds suffer from duration. Cash suffers from erosion. Leverage suffers when collateral becomes expensive. Dividend income suffers when risk-free yields dominate and debt costs rise. Commercial real estate suffers when refinancing meets weak cash flow. And when stress appears, it doesn't announce itself politely. It travels through the plumbing. Rates, to collateral, to funding, to credit, to real economy, to asset prices. People will argue about narratives, but markets don't care about your narrative. Markets care about the balance sheet. Section: What to do. Principles, not advice. This isn't financial advice, so I'm not going to tell you what to buy. But I can give you principles, mechanical ones, because the point of Noir Ledger isn't fear, it's clarity. Principle 1. Know your duration. If you don't know how sensitive your holdings are to rates, you're holding risk you can't name. A long bond fund, a safe dividend basket. Even certain growth stocks, different labels, same exposure. They're priced like tomorrow is cheap. Principle 2. Separate liquidity from long-term capital. Keep cash for function, bills, emergencies, opportunity. A few months of runway changes your decisions. But don't keep cash as a belief system. Cash is a tool, not a plan. Principle 3. Treat leverage like fire. Useful, dangerous, never free. Margin, HELOCs, short-term business debt. When funding tightens, the math changes overnight. If your strategy only works when refinancing is easy, it's not a strategy, it's a bet on conditions. Principle 4. Follow cash flow, not stories. Stories sell, cash flow survives. If an asset needs constant refinancing to look healthy, it isn't healthy. In 2026, debt service, occupancy, and spreads will matter more than narratives. Principle 5. Watch the plumbing. Funding stress shows up before headlines do. Credit spreads, volatility spikes, bank provisions, strange moves in the treasury market, those are signals. When collateral gets nervous, everything else gets nervous.
2026 isn't guaranteed collapse, but it is a stress test year. A year where easy money stops rescuing weak balance sheets. When that safety net disappears, prices don't negotiate, they adjust. And the assets that can't answer will get repriced until they can. Section: A simple weekly dashboard, no terminal required. If you want to treat 2026 like a stress test, you don't need a Bloomberg terminal. You need a small dashboard. 5 signals that tell you whether the system is loosening or tightening. First, the direction of long-term yields. Not because higher yields are bad, but because they set the discount rate for everything else. Second, credit spreads. When spreads widen, the market is charging more for risk. That's usually the first warning that liquidity is getting selective. Third, volatility. One spike is noise. Repeated spikes are a regime. Fourth, bank language. You don't need to read every report. Watch for tightening standards, higher provisions, cautious guidance. Banks are early warning sensors. Fifth, real estate cash flow signals, occupancy and refinancing pressure. When owners talk more about extensions than expansion, you're not in a growth regime. None of these gives you a prophecy, but together they give you a map. And a map keeps you from calling the obvious unexpected. Closing. If you came here looking for a prediction, you'll be disappointed. That's not what this channel does. Noir Ledger is a file cabinet of mechanisms, because once you see the mechanism, you stop being surprised by outcomes. If you want more case files like this, money, incentives, and the hidden mechanics behind finance, subscribe. Not for hype, for clarity. See you in the next file.